Well, good morning to the last day of Cybos, and I can see that everyone has hung on to the last minute to come to the Thursday sessions, which is great. Just to introduce myself, and then we'll introduce the panel more generally. My name's Oliver Kirby-Johnson. I'm a partner from KPMG in the UK, where I specialize in payments, but I've actually spent much of the last 5 years down here in Australia as the program director for the implementation of the Australian New Payments Platform. Now, I won't say too much about that because I think there's been pretty extensive coverage over the last few days about the NPP, which launched earlier this year, and the innovation around the sort of customer-centric product overlay approach underpinned by real-time settlement. It really is world-leading. But NPP innovation is just an example of what's going on in the Asia-Pacific region. The well-respected Global Innovation Index shows a number of countries, including Singapore, Korea, China, Japan, Australia, in the top 20 countries for innovation. And another report, which is based mostly on patent filings, notes that Asia-Pacific accounts for about 43% of the top 100 global innovators, and that's actually an increase on the previous year of some 15%. So even the objective academic views of innovation show Asia-Pacific is a hotbed. In domestic payments, the Australians, apart from MVP, have embraced contactless as a way of life. And a recent study by Global Data showed that mobile wallet adoption in the Asian Pacific markets is far higher than the US, the UK, and Germany. So what is going on in Asia? Is it the availability of low-cost smartphones, rising internet penetration, and growing awareness of mobile payments? I'm not sure it's that simple, because that's true for the European and Western markets as well. So what is it that is different? We've certainly seen some specific things different in terms of QR payments, which are becoming increasingly popular. And that clearly is building on the low cost of accepting those payments and the high customer penetration of mobile wallets. So there is a correlation there. But I think to unpack what's really going on, I'm joined on the stage by 4 experts from very different parts of the market. To my right, I've got Lisa Robbins, the Global Head of Transaction Banking at Standard Chartered. Next to Lisa is Peter Hiom, the Deputy CEO of the ASX Australian Securities Exchange. After Peter is a rapidly growing fintech, James Ma, the Vice President from JD Finance. And at the end is Madhur, Deora, the CFO of PAYTM. And we'll ask each of those two gentlemen to give a bit of an overview as to what they're seeing in the market in a second. So let's turn to the panel. Lisa, you've observed and driven innovation in several markets across Asia-Pacific in your job. So where do you see the innovation hotspots, and what's the secret?
Well, there's no secret that there's a lot going on in Asia, and actually, when you look at what a big bank, a legacy institution like ours does, we're really looking at how we can co-create and looking for areas where people are innovating in big ways. So if I break the market down, I look at China, where we've been, and this is not a plug, but we've been there for a long time, 160 years, and obviously we've seen a little bit of change in the market over those years. Basically, in China, we see it as being driven by platform companies like Alipay, JD, Tencent, and others who are really driving out of the private sector and looking at the big consumer base, and that offers opportunities for tremendous innovation in the fintech side. On the other hand, if you look at India, where we see a really different dynamic, which is basically driven out of I'm simplifying, but driven out of a regulatory need, which was a couple of years ago to demonetize. Out of that, we saw the development of the rails, very much regulated, and then fostering the innovation of new payment systems like PAYTM, who is on the panel. So we look at it and we say, well, where can we play a role? And so we've been actually co-creating with many of these platforms to bring services to our clients, and our clients are both on the wholesale side, the commercial market side, commercial bank side, as well as retail. So it allows us to put the ecosystem together.
Thank you, Lisa. Peter, turning to you, the institutional securities exchanges are not always noted as being a hotbed of leading-edge technologies and innovation, and yet ASX have been making quite a splash this week with a move into distributed ledger technology for the post-trade environment. Tell us more. Was this institutionally driven, or was it fintech pulled?
Yeah, so the securities settlement, the sexy part of the financial services industry historically. Look, I think for us it was in some senses a little bit of serendipity. We began looking at distributed ledger technology when we started to look at the replacement of a core piece of infrastructure for Australia called CHESS. It's a clearing and settlement platform for Australian equities. And we happened to be looking at a replacement for CHESS at the same time as what I would describe as sort of peak blockchain, which would have been 3 or 4 years ago. We started to see the parts of distributed ledger technology that we felt were relevant for financial markets. We also identified some parts of that technology that we thought were not, which we might get into a little bit later. But really found that that was matching up against a challenge that our customers have, which is driven out of regulatory changes, technological challenges, new entrant competitors, that essentially could be boiled down into a very simple thing. They want better data in real time. It needs to be accurate, it needs to be rich, and they need to be able to prove to themselves that it's actually true. And so we found that the likes of ASX as a market infrastructure sort of underpinning the institutional market can actually deliver that data up and allow our customers to innovate. So delivering a platform of real-time data, but also in an environment where fintech and getting co-creation can actually start building applications on top of that infrastructure. I think in the similar way to NPP in some senses, of building applications over the top of the infrastructure that you create beyond the original use case that you created that platform for.
I think overlay service is becoming one of the buzz phrases of the year, so I think you're absolutely right. Thank you, Peter. James, turning to you. It'd be good to hear a little bit about what innovations are behind the extraordinary growth of JD Financial since it spun out of JD.com.
We started our business 5 years ago. When we were still a subsidiary group of JD.com. We spun off from JD.com last year. So in the past 5 years, we started from zero to now, serving over 400 million individual users and over 8 million merchant customers. So by what? By continuously innovations. First thing is we had to, because in China we had a pretty strong banking system already when we started our business. However, we had some advantages there. 2 things. I think one is along with the smartphone or smart equipment were more and more popular, we are able to gather enough data, which is very important. And secondly, we had a lot of we continuously invest in technologies. Over our total employment, about 60% are engineers and data scientists. So together with these 2 factors, we were able to create a brand new data technology-driven business model. Although from appearance, we are providing comprehensive financial services to our customers, and sometimes together with the banks we are partnering with. Very similar, for example, majority of our revenues coming from lending business to the individuals. The business model is pretty similar, like a virtual credit card. However, different from credit card companies, back to 2014, our credit risk assessment system was totally built on big data and machine learning, deep learning models. So we didn't have, until now, we don't have any humans to evaluate any individual applicants' credit risk. So that's totally different from the balanced scorecard system used by the banks and credit card companies. So that's pretty much how we innovate. Yeah.
Thank you, James. Madhur, turning to you, PAYTM is quite a surprise, isn't it? It's the largest mobile payments and e-commerce platform in India, and it's grown so rapidly. So what makes it such a success? Has PAYTM become the new definition of financial inclusion?
Yeah, so we started our journey similar to what James said about 6 years ago. We currently have just under 400 million users and about 10 million merchants where you can go and make payments. I think one of the things that differentiates us is that we want to be the solo payment method for our customers, which is quite different than how banks, especially in emerging markets, have approached customers as well as merchants. So in India, less than 3% of people use cards. Even though they do have bank accounts, they have cards, but they don't use them. And less than 2% of merchants accept cards. Banks were not really that interested in growing that platform, and they were quite happy to be the payment method for certain types of payments, fancy restaurants, shopping, department stores, supermarkets, hotels, and so on. We decided to take a different approach. We said that we want to be a part of every transaction that the customer does, whether it's online or offline, small ticket, big ticket, small merchants, large merchants, organized and unorganized, and so on. And we just want to surround ourselves, surround the customer life. And we don't get to choose where we are available. The customer chooses where they go, and we just have to be there. And I think we're well on our journey. We want to get to about 20 million merchants, which would make us 15 times larger than the card network in India. We are very much a consumer internet company. We're focused on direct relationships with the consumer. That allows us to customize offerings, use big data to show customers things which are super relevant, and also move towards financial inclusion. Because if we have a fair amount of data on the consumers, we can make, for example, loans available with zero friction. Because they're already opening our app, they see that there's a loan available. We have already been able to underwrite them based on their transaction data. In India, a vast majority of people don't have credit files. They don't have bureau scores. So most banks struggle to be able to lend to them. And we're also able to offer them wealth management products. So our idea is that if all you can borrow is $100, you're welcome at PAYTM. And if all you can save is $1 at a time, then we should have products. The technology actually allows you to build products and distribute products which will be relevant to you.
Thank you. So quite a number of themes coming out there. And it's perhaps worth us unpacking a few of them at a time and focusing on one or two different areas as we go. So clearly, for all of these platforms, the ubiquitous presence of smartphones and internet is kind of the hygiene factor. It's got to be there. So there must be something else that's happening in Asia Pacific for it to be such a driver of innovation. And you do wonder, listening to the description so far, whether this is a case of more creative ideas, or whether the funding is there to get ideas to reality, or whether actually it's just pulled through by very rapid customer take-up. I'd be interested in your views. Perhaps, Lisa, you'd like to start.
I think a couple things that probably are not original thoughts, but there's not the same legacy. I mean, when I think of I just mentioned that we have 160 years of legacy, and a lot of large Western institutions have that as well. The legacy isn't there, so there's an opportunity to leapfrog, and we're seeing that happen in Asia because as you mentioned, mobile phones are everywhere, and if consumers want to use mobile to make payments, you can better believe that eventually treasurers will as well. Okay. And so we need to take it seriously. So that's one thing. The lack of legacy, I think, enables. They don't have to deal with how you keep your legacy system going while investing in something new. Everything is new. So that would be it. The other thing you mentioned is the demographics. It's a younger, generally speaking, making another generalization, generally it's a younger population, very comfortable with the use of mobile phones. Mobile phones are, in many places, just a small anecdote, I was trekking in India, in the eastern part of the Himalayas last year, and there was nobody around except a sheep herder and her sheep, or goats rather, not she was a goat herder, and she was on her phone, and actually she was making a payment. I went up to her to find out what was going on, and she was actually on her phone. We couldn't communicate, but I could see what she was doing. So the ubiquity is quite...
Was she a Standard Chartered customer?
Probably PAYTM, not us, right? So mobile phones are ubiquitous in there, and they enable financial inclusion, which is another imperative in this region. When you think of what's going on, I'll point to China and India. Both of those two large masses of populations have a financial inclusion imperative. And I would say I hazard to say there's another thing that's a little bit, probably a little bit more qualitative than quantitative. It's mindset. It's the ability and desire to change rapidly and put the work in to get 24/7 to get things done.
I just maybe just add to that. I think if you look at the consumer side, what's happening now is people say once a generation. It's actually much more unique than that. This is once in 100 years, 200 years, some people say ever, change where you have that much technology in your hands, and it is completely democratized. It hasn't got to every single user, but it has got to some remarkable numbers in countries like India, China, Southeast Asia, and so on. And the growth has been absolutely phenomenal, right? So now users have access to information, they have access to banking which is relevant to them, right? So they can not only check their balances, but they can also maybe have access to loans and so on. So that's a huge transformation that we're going through, and which is different than the West, because I bet most of us who spend any time in the West, we had desktop computers, right? They didn't work as well as mobile phones do today, but we had desktop computers. We went through one technology curve after another, whereas with mobile phones, you are leapfrogging actually several curves, technology curves that the West went through. So you have all of a sudden a large addressable market which just didn't exist before. And you have, I think, entrepreneurs and access to capital, which allows us to build application layers on top of that. So I think that's really what's happening. But at the fundamental core of it is that leapfrogging technology, which is smartphone.
Maybe also perhaps a non-technology point, which is sort of a little bit about legacy as well, which is with legacy comes legacy business models. That's not just about the technology, but actually the challenge of customers transitioning from an old business model to a new one. And we see that in our business as that one of the biggest challenges our customers have in thinking about new technology. And in the case of DLT, that's one of those technologies, is how do I actually move from the old world business model where I was monetizing through, say, transactions, through to a different business model where I'm monetizing through data. And how do I make the investments if I'm a global business? Because it's a complicated equation. So that business model, I think, challenges a sort of legacy issue. I think in the region, if I speak for market infrastructures, I think one of the reasons why we're well placed in the region for innovation is the nature of the business models of the market infrastructures. So they tend to be vertically integrated. They are listings businesses, they do trading, clearing and settlement. They can think about the whole value chain all the way through from the creation of a security all the way down through to the holding and safekeeping of that security. So it allows you to think quite holistically about how you make innovation happen, and it makes you capable of change that is harder in other jurisdictions where a market infrastructure is doing one of those things, but certainly not all of them in a particular jurisdiction. And in multi-asset classes as well, not just in a single asset class.
I think that point around vertical integration is actually quite a key one, because you do see that in the e-commerce portals as well, that it's trying to make a very smooth journey for the whole transaction, from thinking about wanting something, buying something different and paying for it and getting it. James?
Right, in addition to those points, I observed a few more non-technology points. One is the rise of entrepreneurship in Asia. You know, I also take care of investment in our business. So I meet a lot of new founders, young founders. I see many of them, they are young and well educated and inspired by the success of some pioneers like Tencent, like Alibaba, and JD. So they believe, you know, traditionally in Asia culture, normally they have some hierarchy, right? You have to, you know, spend most of the time to learn from your master or something like that. So it normally take you like 20, 30 years to be a leader. But right now, people believe, wow, we can do something by ourselves, and we can create something benefiting the society and good for the human beings. So I think that's one very important factor I can see, particularly in China. These young people, they are very innovative. They have so total different thinking ways from us. So that's one. And the other is, yeah, the capital. Capital-wise, I mean, venture capitals, they made a lot of money in China in the past 10 years or maybe 20 years in internet sectors. So there are a lot of money in the market. So with even a young guy without much experience, as long as he has some good ideas, he can easily get financial support from the venture capitals. So these two factors, the combination of these two factors, I think this may be kind of a region for the innovations, not only in financial industries, but you know, everywhere.
I think
there's just one thing I wanted that's really true, and I also wanted to build on your point, which was on the regulatory environment. If you look at Singapore, where there's actually a stated purpose to become smart nation. And the whole, every aspect of Singapore, regulatory to banking to how you pay your electricity bills, it's all moving towards smart nation. And when you have that imperative, we've been talking about India, China, and Australia, I think we can't forget that we live in a region that's much bigger. And this is happening across the region. Thailand, real-time payments, Hong Kong, a whole host of things happening, both regulatory-driven and private sector-driven.
So I was just going to say, it's interesting, isn't it? You can have at both ends of the spectrum. I mean, on the one hand, you can have the larger countries where you can drive adoption of new technologies rapidly because there's not the legacy. Right. And then in the smaller countries, maybe in Singapore, maybe here in Australia, you have first world regulatory infrastructure. You're large enough to matter, but small enough as a place to start as well. So you can actually drive adoption of a new technology because you can get a combination of a will of a government or a will of a financial services sector to say, we're actually going to change this. And actually our customers who do business in all other parts of Asia and the rest of the world can gain something from adoption in that country to begin with, and then learn from that and then drive adoption elsewhere.
I think it's interesting, particularly when you pick on an environment such as Singapore, where they're quite smart in their interventions around it. And one of the things that struck me over the last few weeks was the drive to have a standardized QR code, for example, for payments, because you were beginning to get a plethora of QR codes for different mobile wallets and mobile payments mechanisms. And they've said, no, for this market to work, there's got to be one sticker on the retailer's till, and it's got to be a QR code that everyone recognizes. So sometimes you can have a relatively benign intervention by a regulator. So I'm intrigued with this because we've touched on demographics and we've touched on culture, and we've touched on the nature of regulation. But I can't help feeling that sometimes just the sheer size of the market makes a difference. So when you look at the population of the US and the countries in Europe, and then you compare it to China and India, which individually have populations in excess of 4 times of that in the US, just as a proportion, and then you look at regions and other countries like Indonesia, which are rapidly coming up behind it, that must help, mustn't it, in terms of take-up? Because if you've got a good product, it's easier to expand in a single market than it is perhaps to go cross-frontier.
I would
Lisa,
I was just thinking about what he said about client adoption and the U.S. Take the U.S. Checks. Checks are still written. It's about changing customer behavior. So when I think about checks, you know, they get on a plane, they fly to Kentucky, get taken out of the plane, then they get on another plane, and they go somewhere else. Obviously, they're becoming digitized. But we still in the U.S. write checks. I bet this audience doesn't write, just looking around, probably you don't write very many checks if you're living in a different part of the world. So I think part of it is getting getting the mindset and the customers to adopt, as you were saying, to new technology. I mean, we don't have legacy.
No, I think that's a fair point, but I didn't get the impression, and Madhur and James, I'd be interested to hear your view. I didn't get the impression there's much regulatory push behind people moving to the types of platforms and services that you offer. There seems to be a pull take-up. Consumers want to use what you provide.
Yeah, I think you go out and make a bet that the time has come where consumers have enough technology to fundamentally change the way they do these things, right? So remember, in countries like India, and I think it was similar in China before, people were not going online and going to their bank's website to make a payment, right? So you're not really disrupting banks. You're not disrupting payments in the truly technical sense, right? There is actually, honestly, nothing to disrupt. What you're trying to do is help people so that they don't have to stand in a line for 30 minutes to make a bill payment, which is very inefficient. There's a cost involved which has to be loaded onto somebody, usually the customer. And it's highly inconvenient, and people are spending all this time, wasting all this time. To your question earlier about does the market opportunity lead to some of these successes? I would say yes and no. I think it's obviously truly exciting for entrepreneurs to be able to go out and say we can change 500 million lives for the better. We can, and it's not just about payments, it's also about financial inclusion. It's about people who have been left out of the mainstream economy, for them to be able to come back just by just virtue of the power of having a mobile phone and us building applications on top. But the flip side of that is a lot of our countries are very diverse, right? The gaps between rich and poor is very large. In India, it's also culturally very diverse, many different languages. Urban, rural areas have very different dynamics. There is a lack of real anchor use cases around around which you can build a payments network. So, for example, in the US, there would be organized retail everywhere. There would be a Starbucks everywhere, so you could build a payments network which is accepted as Starbucks and then expand it to other places. In India, as you get beyond 30 or 40 cities, there's not as much organized retail. There wouldn't be chain coffee shops and online or offline. So you have to be truly innovative about, as you go deeper into the country, you have to think about new solutions. Your business becomes more complex because all of a sudden you're handling customer care queries in like 15 different languages, and you have to employ people in 15 different places to be able to do that, just as one example. So, but those are good learnings. Those are good innovations and learnings as a company, that you have to be agile, you have to listen to the customer. And I think going forward, more than anything else, it is that culture and attribute of the companies that will matter. Technology curves are becoming shorter. So it's not about, did I choose the right technology necessarily? You can always ride the next technology wave, right? But what's going to matter is that, do you have, as a culture of the company, that you're able to make fast decisions, you're also able to kill decisions that you made, and you're able, and you have this mindset of investing in technology and people and listening to the customer. Yeah.
So James, this must be very similar in your operation. Well, as a country, China has many time zones and many languages. So.
Actually, in China, we are using unified Chinese, at least in written, so it's better than India. But in my point of view, sorry,
I think that was a compliment.
I think the market size matters. Maybe it doesn't matter, but you need to figure out a different way to do your innovations. For example, we regularly travel to Israel to meet some of the staff, technology staff there. And because the Israel market is definitely very small, so those guys, although they are very technology advanced, those guys are really smart. And, but their business model is always to be. Their customers, their target customers are always big financial institutions in the States, and now they are thinking about China. So they have their own way to make profit. Or I think the key is how do you build up a sustainable business model could last for a long time. So that in Israel, you can see many founders. They found a technology company, and after 2 years, they sell the company to, for example, Citi or maybe Standard Chartered. And then he started up another business, another technology company. I met Israel founder who already sell 4 companies to financial institutions in the United States. So I think that in a small market, you have your own way. And in a bigger market, like in China, innovation, I think in India is, well, everywhere, same thing. Innovation, we cannot just do innovation for innovation, right? We have to do it to make it a commercially sustainable business model. For example, when we talk about financial inclusion, in China, we are providing very interesting services. Most of our customers are living in cities, but we do have providing some services in agriculture. Like, for example, poultry breeding. Poultry breeding is it's an old-fashioned business, right? Lasts for maybe 1,000 years. And in China, normally the slaughtering houses, they hire local farmers to raise chicken for them. And the farmers, they normally get financial support from the government, from banks, with government subsidized loans with a very low interest rate, like, for example, 6%, 5%. However, they have to withdraw the loan in a lump sum basis with a term like 3 to 6 months, and they have to provide some collateral. And so that's, but the breeding process for chicken, actually the whole cycle is 42 days. But they have to lend the money for like 90 days, right? So how do we do? We realize one thing, the readiness, data readiness in breeding industry. In poultry in China, the slaughtering houses are very big. They have their own ERP system, so they can gather data from, for each farmers. So by then, we provide our risk control and our risk assessment system, based on their data. So the farmers, they don't need to provide collateral to us. And also, the whole process, we provide our loans very precisely, progressively with their breeding process. So although we charge 11% interest rate to the farmers, almost double the interest rate they pay to the banks. But the total actual interest cost burden of the farmers are 60% less than they're borrowing from banks. So that we can, with this higher interest rate, we can make profit, and the slaughtering houses can make profit, and the farmers, their burden is lower. So this is how we innovate. Not only based on technologies, but also we try to build a sustainable business model.
I think that's, you've brought out 2 or 3 themes there, which I think are possibly worth us exploring. So you mentioned the sort of serial entrepreneurs who create good ideas and move on, sell it, build a new one, sell it, move it on. You've talked about how you can come up with ideas where you create a dynamic with your customers where both sides are winning out of it. And you've also talked quite a lot about data. And one of the questions we've had from the floor is about the role of artificial intelligence in managing the data and using it to help focus innovation and to drive business models. So, Lisa, I don't know if there's something you'd like to add on that.
We obviously believe it's critical. It's not to be ignored. It's being used in many different areas. And as an institution, we have over 200 million points of data just for our cash and trade business, not to mention the security services business. And so we are obviously looking at ways where we can take that data and make it useful. The problem is how quickly and using what processes. So we look at data as being actually the new engine, and you spoke about that earlier. As really, you're looking at data in terms of what you're doing on an ASX, and that's where we see the whole industry going, to becoming much more focused on how we can extract data to enable companies to do what they've always done, always wanted, which is to make payments, concentrate their investments, and store their money in a safe and sound way. So the more information we can get about how that's done, the better we are able to service our customers. And we're spending a lot of time and effort focused on that. We also see that in other areas, of course, and I'll let my other co-panelists talk about how it's being used. Well, we're using it also in the back office, but also on e-commerce platforms.
I'd like to pick up on that, actually, and perhaps turn to Peter to get a slightly different perspective, because data is clearly central to everything you do in the ASX, particularly post-trade. How do you deal with the sensitivity of the data, the need to have data, and the sensitivity with regulators about the security and trust that they can put in the data?
Yeah, okay, so I mean, I think that's fair to say that that trust is kind of the center of everything that we do, and our regulators have an expectation that, you know, every day when everyone wakes up, the same number of BHP shares are in existence as they were the previous day. We don't expect there to be any mistakes, or that somebody who thought they had shares turned out they didn't. So it's obvious that trust and data has always been important. It'll be the only comment I make about distributed ledger technologies generally when I make this comment, which is the notion of the sharing of the entire data set with everyone in the system, and the only thing that protects the privacy of that data is cryptographic security, is a non-starter in financial markets, largely because one thing we know to be true about cryptographic security is it will be broken at some point. And if you have a blockchain that is shared with everyone from day dot, then at some point somebody is going to unlock the keys to all the data that has been previously shared. So data privacy, segregation of data to individual customers is a fundamental tenet of everything that we do, and the technology innovations that we've participated in are all about preserving that integrity and demonstrating to our regulators that that continues to be the case. In fact, showing regulators that in many ways some of these new technologies can become all-consuming to those that think about them, and they become a thing in and of themselves as opposed to a tool to solve a problem. So once you go back to what is the problem you're trying to solve, you can actually have a sensible conversation about why the technology lets you do that. It's a little bit like early days of DLT. It's like, we need a DLT, we need a blockchain in our business, or we need an AI tool, without actually knowing what it is you were going to use it for. So you go through the process of trying to understand the technology, and then you pull it back to what is it you're actually trying to solve for. And we're not trying to solve a trust problem in financial markets. We're actually trying to solve a data synchronicity problem. So you've got to prove to your regulators that you can synchronize data across multiple users, that they can prove to themselves that it's true, but preserve the privacy of data as you do that. So not enough time today to explain how you do that, and please come and see me afterwards if you'd like a Merkle tree conversation about blockchains. But broadly speaking, as financial market infrastructures, actually lots of things remain true regardless of these new technologies. We have to make sure that the technology meets those requirements of regulators around, you know, security, resilience, scalability, and privacy of data.
I think, again, that's an interesting balance, isn't it? Because one sometimes wonders whether innovation is happening purely through the drive of entrepreneurs, and quite often serial entrepreneurs, or whether regulators sort of force innovation to happen. But I think what I'm hearing is that quite often they're hand in hand. So you either innovate and regulators have to be comfortable with it because they can see why it's better, or alternatively, they can drive simplification, as we've seen with things like open banking, which then allow fintechs to take off.
Well, we've actually seen that we've seen that all over the region where the regulators are actually at the forefront in some respects of helping to drive innovation. Again, using the Singapore example, Hong Kong, where they've launched the trade network, as well as the linkage between Hong Kong and Singapore. And actually SWIFT GPI is, well, it's not a regulatory thing, it's becoming a very standard way of transacting. So we see it as the regulators are in some countries are are aiding and abetting the development of new technologies, and in other countries they're just not there yet.
And I delve into that again, maybe, and not for a purpose in and of itself to drive, but because it's actually achieving a regulatory objective by using that new technology.
Right. Safer, sounder.
Yeah.
Yeah.
So perhaps just pick up with Madhur. I mean, how do you square your business model around financial inclusion through PAYTM with what regulators would like you or not like you to do? Presumably that's quite a fine balance.
Yeah. I think our understanding of what regulators care about is, first of all, the safety of the systems, right? Safety, stability of the systems. And we break it down into, you have to keep customer money safe. You have to care about money laundering. You cannot have data security or data privacy issues. And you shouldn't missell products. Right? I mean, there'll be other points, but these are 4 fundamental points as we understand it on safety. But in emerging markets, regulators also have a different challenge, which is that of access and efficiency of these platforms. And they cannot ignore all of the technology that is around us now. And the consumer expectation has changed dramatically. Right? If I can send a message from me to anyone in the world or to hundreds of people in the world in my WhatsApp group or on a Facebook post, and it's all available instantly, why should it take 3 to 5 working days for my money to go from one place to another? And that's just almost a dirty term, 3 to 5 working days, right? Customers will not accept that, and customers will see what's happening around the world, and they will, and the regulators will have this objective of making this access available. So we have fundamentally seen regulators do this 2 different ways. One is pushing existing companies to become more innovative, to open up their systems, and to provide greater access. And the second is to work on new regulations which allow new types of companies to come and build largely on the outside of traditional companies. We took that route, but one thing is very clear, I think for any fintech company here or around the world, that if you have big ambitions, if you want 500 million users like we have been saying, we're well on our way towards that, you will be regulated. You will want to be regulated, and it's one of the things that you should learn as a company is how do you work in the regulatory framework, right? You're not going to handle money of 500 million users and not be regulated. So the earlier you learn that, and the earlier you figure out the regulatory frameworks which you can comply with and which and start that dialogue with regulators, the more prepared you'll be as a company, and there'll be it will be a differentiator, because technology companies understanding financial services and then also understanding regulatory interaction and regulatory environment, that's the complete package, right? What you have, on the other hand, is financial services companies who are regulated, who are trying to understand technology, or at least the new types of technologies. So that's really, in a sense, I mean, I don't mean to over-dramatize this, but that, in a sense, is the battle for customer share. It is quite clear in most places around Asia that the customer interface will likely be a new age financial services company, right? It is true in India, where they launched money transfer with bank-to-bank money transfers, but vast majority of the transactions are happening on third-party apps. They're not being initiated on the bank's app. That is true, of course, in China as well, that people use third-party apps to do money transfer as well as payments. I'm not saying it's good or bad, but that is the direction that we're going in, is that we don't have enough evidence that it will be the bank's app. So we will have to work together between traditional banks, where most of the money is sitting, regulators who regulate these banks, as well as new age companies who have a responsibility to do things in a responsible fashion.
I think you touch on an interesting facet there, which is that increasingly the boundaries are blurred between personal and corporate work life. And we're increasingly seeing, if not a convergence, at least a blurring of the products and approaches to wholesale, corporate, and personal payments. here in Australia, for example, you know, it was recognised that people like to send emojis in their texts, and you can now send emojis with your payments if you're sending an Osco payment. Short plug there. So it recognises that you can't delineate the way society is going, the culture is going, to the way in which you support businesses. Is this a trend that you're seeing increasingly across your remit, Lisa?
We continue to see that. Clearly, with what we've talked about, the rise of mobile payments as the mobile phone, we're seeing treasurers wanting to use their mobile payments to manage treasury and have that real-time ability to see real-time information and make decisions. So I think it's inevitable. Why would you behave differently in your private life than why would your expectations at home be different from what they would be at work? The big difference, of course, is that it has to be safe, sound, as it should be in your private life as well, but safe, sound, and managed in an effective way always. But I see that as the trend, and that's what we're discussing. Actually, we had a bit of a debate in our own team about how quickly that would happen. And some people believe that you can split your personality in two and be one person at home and another person at work and use different tools. I think eventually those tools will converge. You started using an iPad for fun, I bet, and now we use it as a tool at work. So I think this is inevitable. We're seeing it happen. We're meeting with treasurers and CFOs to discuss what technologies they're using, where they see their business going. We've actually drawn out maps of what we think the future will look like for security services, for trade, and for cash. And we've looked at our customers' maps. And the tools that they want to use and they will use are no different. It's the technology that will enable it.
Maybe I'll give you one example of that. So we have a very large number of merchants and consumers who have never used digital transactions before. They've not gone and paid a bill online using a bank app or done money transfer. So the way it works is the consumer walks into a store, they scan a QR code, and the merchant receives the money instantly. We used to have the money being stored in the merchant wallet, but those numbers became very large, so we said the merchants can also transfer money to their bank account. Now we have the largest customer care query that we get from our merchants is that I sent the money to my bank account, it hasn't reached there yet. And we say it will come in 2 to 3 working days because that's what the banking system supports. But vast majority of those queries are in less than 2 days. So now this merchant has this expectation that money transfer is always real time, because I used to accept cash, always real time. I accepted PAYTM, always real time. But then when I send it to my bank, what is this 2 to 3 working days? I think merchants fundamentally don't understand batch settlement or overnight settlement or 2 to 3 working days. They said, I send the money.
It's changing.
It is. It is changing for the better, as in they don't need to understand batch settlement because everything will just happen real time. But that's I think, an illustration of there's a certain type of technology that they're experiencing for one type of payments, and there's a different type of technology that they're experiencing to send money to their bank, and they just simply don't understand that if the money has left their account, why hasn't it reached the other place yet? And there's just this intuitive expectation that everything will just happen in real time.
And I think it will become a reasonable expectation that those things become more real time. I mean, maybe another example of where institutional and retail come together. Take an annual general meeting of a listed company, where it is still an amazing notion that an investor could sit in an AGM and on their mobile phone vote on a proposition from the listed company, and for that to just be automatically recorded. We're still folding up pieces of paper and shoving them in a box. And yet at home, you can have a digital experience. You'd say, well, that just makes no sense to me. And you've got a listed company secretary who, again, like a risk manager or a treasurer, has an expectation that on their mobile phone, they should be able to see the entire register of the listed company and who holds the shares. And yet you would be surprised how hard it is today to actually establish that fact, because the data is not available.
There is an issue. The regulators do have to accept the fact that we move everything digital. Because in many places, we still need we receive digital things, then we have to print paper.
Right.
So there's a catch-up that has to take place.
And also, and an assumption embedded in some of those processes that they are actually much more secure than they really are, and that you're actually moving from here to here when you digitize something, when in most cases you're actually moving from here to here, as long as you can get the identity management part of who is the individual correct. But from our perspective, it's still about the data. It's still about the provision of the data and the security of the data and the provability that the data you're looking at is correct.
And it's that democratization as well, isn't it? The fact that the data should be the same for everyone wherever you are, whether it's in your personal or corporate life, I think is a very powerful trend. And the expectations are rising on investors wondering why they're not getting their dividends the day that the company pays the dividend. It's the same, except it's not 2 days, it's 14 days. Yeah.
Now, then I started to ask, 40 years, twice a year, 14 days I haven't got the money, I'm pretty sure that's going to show up in my pension performance. Yeah. And who's got my money? Yeah. Yeah. Where is it?
And there's a lot in the super funds in Australia.
Right.
Yeah, I want to provide another maybe different but interesting point. When we talk about the blur between personal or retail business and the corporate, we are thinking more. We do provide payment services in China, mostly to the merchant, but we don't simply provide payment services to them. We think that for them, the most thing they care is doing business, right? So how can we are not only providing a service to them, but also help them to have maybe more revenues or more businesses. So in addition to the payment system, we also embedded in our system ERP and also with some hard equipment like cashier, how do I say, POS, smart POS. So we also, because we are coming from JD, so we have a supply chain, total supply chain on goods, right, on the physical goods they're selling. So we combine everything in one system to provide to the owners of those small business. So I think that's maybe another way. I think the boundary, we are talking about the boundary within financial industry, but maybe the boundary in and out financial industry could be gone in the future. So that's one thing we are actually exploring in China. Yeah.
I think one of the things that you build as a payments business is distribution, not just on the customer side, but also on the merchant side. And that's very powerful. So if you just take a step back, we've talked about technology in the consumer's hand. We've talked about, when we're talking about AI, and you just think about that, the reason we are even talking about that is because computing power has become so cheap. So you're talking about enterprise computing power in the cloud. So that allows us to talk about AI and big data and so on. And then the third piece of that really is free software to merchants, right? So there are a very large number of merchants, especially in countries like India, who have zero access to technology. So what we find is that the vast majority of these 10 million merchants who accept payments using PAYTM, we are the only large company, only technology company that talks to them directly. Of course, they have some distributor who comes and stocks soaps and shampoos if they are an FMCG retailer and so on, but it's through many hops in the channel. So we're able to go to them and say that there is technology that you should adopt for things as simple as billing, things which might be mandatory as tax filings, because a lot of these people are coming into the tax net in our countries. And as James mentioned, for ERP, for procurement, because the customer who walks into that store wants to have roughly the same experience as they would online or in an organized store. So for example, if I can go online and buy a product with deferred payments, I want to be able to do that in a small store as well. But a small shopkeeper has no ability to provide that because large banks are not going and offering those EMI products or credit card companies at those branches. So they want large technology providers to actually solve those problems for them.
Right, by doing this, actually, we are gathering data from those small businesses. We know them, better than themselves.
Yeah.
So when in banking, we say KYC or KYB, right? So by doing this, like PAYTM and us are doing, we know them better than themselves. So we can do a lot of things.
So you can help them. I'm conscious we're getting close to lunchtime, so I will just ask one last quick question, and you're limited to a few seconds response as we go around. So we've talked a lot about innovation and the challenges in it and the speeds at which different institutions are moving. So what do we think? Is it going to be the mobile payments and e-commerce sites that are actually going to win out in this, or are the banks' infrastructures going to be able to keep up with the real-time revolution? Lisa?
Oh, we're working together. Co-creation, collaboration, joint success, neither one nor the other, together.
Peter?
Yeah, I agree with that completely, and I think one should never underestimate the either side in that equation. The banks and the market infrastructures have an incredible reach. The new e-commerce and payments infrastructures have incredible innovation, and it makes complete sense for the two to be working together.
Yeah, I can't agree more. I think that the combination of the capabilities of two sides can create more valuable services and know your customers better. So definitely a partnership in the future.
Yeah, I think I agree with all of that. I think the nuance is, who does the customer think that they're banking with? Right. And when the customer thinks about a use case, which institution are they thinking about, right? So if I'm making a payment, do I think of a bank or do I think of a third-party app? When I'm trusting somebody with my money and depositing my life savings, do I trust a third-party app or a bank or a wealth management product? And who's actually distributing that wealth management product to the customer, and who's adding more value in bringing access and the right product to that customer? Right? It's a classic with a manufacturing or distribution. So a lot of the manufacturing may still sit with the banks, but I think more and more of the distribution will move to new age companies.
So I'm hearing the conclusion is that they have to work together. The banks and infrastructures have to keep up with the front-end customer, consumer commerce, and together innovation happens. I'd like to thank Lisa Robbins, Peter Hiom, and James Ma and Madhur Deora for being a fantastic panel, and I hope you've enjoyed it too. Thank you. Thank you.